I bet you didn't know there's a special surprise worth rupees 21,000 for those who watch till the end. Imagine this. You've invested your hard-earned money in a company. It seems solid, reliable, a real winner. Then, bam, a scandal hits. Headlines scream about fraud, corruption, or worse. Suddenly, your safe investment is in free fall. Your portfolio takes a nosedive. This isn't a nightmare scenario. It's the reality of the stock market. Corporate scandals can destroy companies and devastate investors. Remember Satyam Computer Services? This Indian IT giant was flying high until a massive accounting fraud came to light. The stock crashed, wiping out billions in investor wealth. These events are stark reminders that investing always carries risk. Understanding how scandals impact stock prices is crucial for any investor. It's not just about numbers, it's about protecting your financial future. So, buckle up. We're diving deep into the world of corporate scandals, their impact on the stock market, and how you can safeguard your investments. In simplest terms, a corporate scandal is a serious ethical violation by a company or its leaders. Think accounting fraud, like cooking the books to inflate profits, or insider trading, where executives use private information to make money at the expense of regular investors. Then, there are environmental disasters caused by negligence, like an oil spill. Don't forget about product safety issues, where companies prioritize profit over consumer well-being. These are just a few examples. The common thread? A betrayal of trust. Companies are expected to operate ethically and transparently. When they don't, it erodes investor confidence and triggers a chain reaction in the market. These scandals aren't just bad for the companies involved. They damage the entire market. They make investors wary and hesitant to invest, which can stifle economic growth. News travels fast in the digital age, especially bad news. When a scandal breaks, the media pounces and investors hit the panic button. It's a chain reaction. First comes the news, often followed by investigations and lawsuits. Uncertainty reigns. Investors hate uncertainty. They start selling, pushing the stock price down. This downward spiral can be swift and brutal. Take the case of a hypothetical Nifty 50 company. Let's call it Tech Solutions. Imagine news breaks that Tech Solutions has been falsifying its revenue numbers. Investors, worried about their investments, start selling their shares. This selling pressure leads to a sharp decline in Tech Solutions' stock price. Other investors, seeing the price drop, might panic and sell too, further accelerating the decline. Let's look at some real-world examples from the Nifty 50, India's benchmark stock index. Remember the Yes Bank crisis? This once prominent lender faced a severe liquidity crunch due to alleged mismanagement and bad loans. The stock price plummeted, wiping out a significant portion of investor wealth. Then there's the case of DHFL, a housing finance company. It faced allegations of financial irregularities and ultimately filed for bankruptcy. Its stock price crashed, leaving investors high and dry. These examples highlight the devastating impact of scandals. They underscore the importance of due diligence and understanding the risks involved in investing. Section 5. Charts don't lie. Technical analysis after a scandal. Technical analysis, the art of studying price charts, can reveal a lot about a stock's post-scandal performance. Often, you'll see a sharp drop, followed by a period of volatility.
Imagine looking at the chart of a company hit by a scandal. You might see a death cross, a bearish signal where the short-term moving average dips below the long-term one. Volume might spike as panicked investors rush to sell.
These patterns can help investors identify potential buying or selling opportunities. However, it's crucial to remember that technical analysis should be used in conjunction with fundamental analysis, which we'll discuss next. Section 6. Beyond the numbers. Why fundamentals still matter. While charts can be insightful, they don't tell the whole story.
That's where fundamental analysis comes in. It's about understanding the company's business, its management, its financials, and its future prospects. After a scandal, scrutinize the company's response. Are they transparent? Are they taking steps to address the issues?
A strong, proactive response can sometimes lead to a recovery in stock price. Remember, a scandal doesn't always mean the company is finished. Some recover and emerge stronger. Others, however, falter and fade away.
Fundamental analysis helps you separate the wheat from the chaff.
Section 7. The big lesson: protecting yourself from corporate crooks. The most crucial takeaway: investing involves risk. Corporate scandals are a harsh reality of the market.
But you can mitigate your risk through careful research and due diligence. Don't just chase returns. Understand the businesses you're investing in. Scrutinize their financials, their management team, and their track record.
Look for red flags like excessive debt, questionable accounting practices, or frequent lawsuits. Remember, diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes to reduce your exposure to any single company or industry.
Investing is a marathon, not a sprint. It's about making informed decisions, managing your risk, and staying the course.
Section 8. Ready to level up? A special offer awaits. Congratulations! You've just completed this deep dive into the world of corporate scandals and their impact on stock prices. You're now better equipped to navigate the market and make informed investment decisions. But the learning doesn't stop here. Subscribe to our newsletter now and receive a special surprise worth Rs 21,000. You'll gain access to exclusive market insights, expert analysis, and actionable trading tips. As a bonus, you'll also receive our suite of financial calculators absolutely free. These tools will help you analyze stocks, manage your portfolio, and make smarter investment decisions. But that's not all. We're also offering a special discounted rate on our acclaimed How to Automate Trades course. This comprehensive course, usually worth Rs 7,000, is now available for only Rs 99. Don't miss out on this incredible opportunity. Click the link below to subscribe and claim your special surprise worth Rs 21,000. After subscribing, send a screenshot to WhatsApp number 9113211787 to claim your Rs 21,000 worth of 5 financial calculators.